A very good morning. This is Business Live with me, Darren McCaffrey. Donald Trump may have already shaken up the world in his first 6 weeks, but we'll have more on that as we talk to him. Let's bring you the rest of the headlines. Let's talk about borrowing, because borrowing costs across Europe as Germany relaxes its debt rules. Plus, 5 years on from the advent of hybrid working, how do people feel about going back to the office full time? Let's try that again. Very good morning. Welcome to Business Live with me, Darren McCaffrey. Now, Donald Trump may have already shaken up the world in his first 6 weeks in office, but he is just getting started. That was the main message, at least last night, from his speech to Congress. He declared that America is back and its tariffs will make the country rich again. On the negative side, though, market reaction to his plans, he said that there will be a little disturbance, but we're OK with that. It won't be much. That's what Donald Trump had to say. What about the rest of the world? Let's speak to Maximilian Hess, who joins us live this morning. Very good morning to you, Maximilian. First of all, he talked about disturbance, didn't he? And that's because there was an expectation, at least from some in the markets, that this imposing tariffs was a negotiating game rather than something he would actually really go ahead and do.
Yes. Well, thank you very much for having me. Trump had really talked a tough game on tariffs, and we'd seen him use them as threats a lot. But a lot of his allies had essentially said that this is what Trump wants to use to get certain policy concessions, but now have changed their own rhetoric to say that, no, Trump really does believe that this is necessary for rebuilding the American economy, for providing a new base for revenues, but faces a major challenge as these are going to be inherently inflationary for the United States.
And that's the point, isn't it? Because when you look at what's happening in the US, the US economy has been pretty robust over the last couple of years. There's no doubt about that. But there are warning signs or hints that things might be a bit tricky, not least of all sticky inflation.
Certainly. And we've seen a number of other warning signs flash red. The Federal Reserve's Fed Now tracker showed it was forecasting GDP declines earlier this week off the back of a lot of those tariffs. And this inflation question is really difficult because Trump had promised during the campaign to lower the prices of key commodities. He often spoke about eggs in particular, which is a very salient issue in the United States, where the price inflation has been far higher than it has been here in Europe. But these tariffs will probably reverse that. And we've even seen Trump come out and announce new tariffs on, for example, agricultural imports, which is going to be very disruptive because there's a lot of circular agricultural trade between the United States and the rest of the world. And we've just yesterday got China's response, where China is directly going to put tariffs on some of the U.S.'s own agricultural imports. So market disruption always leads to inflation, not to mention the added prices that the tariffs quite literally put on the goods imported.
In saying that, Maximilian, we did also hear from the US Commerce Secretary yesterday suggesting that Donald Trump is open to a deal, if you like, perhaps unsurprising, and that these tariffs aren't necessarily forever.
Well, I think we are going to see a lot of volatility with these tariffs. As we discussed earlier, Trump has used them as threats. I think some of the more bombastic ones, for example, the tariff threat that he put on Colombia over a spat over deportation flights shortly after his presidency, was very quickly unwound. The Mexican president has said she hopes to hold talks with over these issues with Donald Trump over the coming days, and will be delaying Mexico's own retaliatory measures. But for us here in Europe, both in the EU and the UK, I think it's really important to read through exactly what Trump says, and the frequency with which he has talked about VAT and talked about that as a trade barrier, even if that's not actually what it is, I think shows that he does have a real intent to try to raise these costs. And we know from Donald Trump's long time in the public sphere, it's been since the 1980s where he's talked about the cost differential between, for example, U.S. automotive sales to Europe and European automotive sales to the United States. Now with China as a new rival and particular leader in EV production, of course, that touching on his close ally Elon Musk's business. There's all to play for here, but I do think markets are bracing themselves for far more before there's any alleviation.
And yeah, just very finally on that then, Maximilian, I mean, where are we looking at next? He's talked quite negatively about the EU in the past couple of weeks. a little bit more favourably towards the UK, though?
He has spoken more favorably towards the UK, but of course, J.D. Vance, his vice president, yesterday gave an interview to the BBC in which he besmirched the record of British forces and French forces and their contributions to the U.S.'s war efforts in the last few years. And I think Donald Trump does have a genuine soft spot for the United Kingdom. It's, of course, where his largest foreign property investments are and his golf resorts, particularly in Scotland. But I don't think that that means that we're fully out of the crosshairs yet.
OK, great stuff. As always, Maximilian Hester, thank you very much indeed.
Thank you for having me.
Now, the cost of borrowing has surged across Europe today after Germany's Chancellor-in-Waiting Friedrich Merz announced that he was relaxing the country's debt rules. Let's get a bit more on this now with Anna MacDonald, Investment Manager at Aubrey Capital Management. Anna, good morning, as always, to you. Just talk us through what has happened here, because they're talking about quite significant constitutional change in Germany in reference to this so-called debt break.
Yes, exactly. So the CDU-CSU alliance and the Social Democratic Party, they're expected to form a government coalition, and they have agreed to loosen the country's strict borrowing rules. Now, what you find is that Germany has a very much lower debt to GDP ratio than you do in other countries. So it's in the mid-60s. Compare that to France at 110%. So what they've done is that they've said that they're going to announce a 500 billion infrastructure spend over the next 4 years. And also they're going to exempt any spending above 1% of GDP from the fiscal rules. So this has given this will give an economic boost, but it's also meant that we know that they're going to have to borrow more, so that's pushing up those borrowing costs. And yields have risen sharply, which means the cost of borrowing has gone up from around 2.3% a couple of days ago to the nearly 2.7% today.
Yeah, indeed, and it's also pushing borrowing costs up across Europe. A slightly better day for the markets, rebounding largely today in Europe and indeed here in the UK with the FTSE up a little. And I suppose this is the roller coaster ride that, you know, many investors are simply just going to have to get used to, with Donald Trump and his pronouncements swinging the market one day and it maybe bouncing back the next.
Yeah, volatility is much higher. There's ways of looking at that. There's called the fear gauge, the volatility index, and it is at much higher levels than it has been over the last few weeks. And I think that's because, as your previous speaker was saying, it's not just talk about tariffs coming through. They really are, and that's allowing a lot of uncertainty. But there are hopes that actually some of this spend in Europe will lead to better growth, particularly for some for the infrastructure players. We're seeing cement names, for example, in Heidelberger Cement in Germany today rising sharply, and we've seen the defence names, which were very unloved up until the Ukraine invasion. We've seen them really rally very sharply.
Yeah, and it's fascinating just looking at the currencies there. The sterling is way up against the dollar in recent weeks. I mean, at levels we haven't really seen since the third quarter of last year. And the euro is also at its highest level since November against the dollar, as the dollar weakens, doesn't it, Anna? But let's talk about the European Central Bank, because it's got a decision to make on interest rates later on this week. What do you reckon is going to happen there?
The market is pricing in another cut coming through, and that's because the ECB, like other central banks, will say they're data dependent. So what they're doing is they're reacting to the data that they see in front of them. And whilst we might see the spending, particularly the infrastructure spending, boosting economic growth, that takes a while to come through. So there is still the room to cut rates, and inflation is actually, one could say, slightly more under control in the euro area than it has been, for example, in the UK and in the US. So we do anticipate a cut, and it'll be interesting to see how that plays out in terms of future potential cuts over the year ahead. OK, Anna, as always, appreciate your time on this Wednesday morning. Anna MacDonald there, live for us in Edinburgh. Thank you. Thank you.
Now, President Trump's stance on Ukraine has sent shockwaves across Europe and led clearly to a big rethink on defence spending. Well, I've been speaking to Rob Murray. He's a former British Army officer and also a former head of Innovation at NATO, but he's also the founder of a new Defence Security and Resilience Bank. And I asked him how that bank would work in terms of trying to boost defence spending across Europe.
Essentially, what the DSR Bank is trying to do is really trying to solve for three problems. The first is we've got to get cheap access to capital into nation states fast so they can spend on defence. The second is that even if we achieve that, we've got to help nations get better at defence procurement so you can actually get that money out the door, because there's no point having all of that cash landing in ministries of defence or wherever if you can't spend it. And the third problem we're solving for here is that even if you achieve those first two things of getting cheap capital, helping procurement in terms of getting governments to spend that money, we have to make sure that there is enough capacity and production in the private sector to actually scale up and build everything that's needed. And so the bank would also provide guarantees to commercial banks to help flow the credit that is necessary to get down into the supply chain as to where that is needed.
Where would the money come from, though? I mean, who's going to fund this bank, if you like?
Yeah, so essentially the model for this is very much based on multilateral banks. So think like the World Bank, the European Investment Bank, and the way in which these are funded is nations are the shareholders, and they invest around about 15 to 20% of the actual balance sheet. And that's spread amongst all of the national shareholders. And that money, though, it's like I say, it's an investment. It needs to be seen as that as opposed to a cost, because that money starts to go into action and starts to flow back into nations to actually drive economic activity and growth. So with regards to where does the money come from, like all multilateral banks, the UK is a member of many of them, it would come from nation states, but actually it needs to be viewed not as a cost, but as an investment.
You seem to have been suggesting, though, that one of the reasons that actually our defences, particularly in Europe, aren't as good as many would claim they should be, is not just because of money, and money's clearly been an issue. There's a general acceptance now that there has been a lack of investment, but you're also suggesting that we don't necessarily have the best procurement systems in place, or indeed even production facilities in Europe. The question is, how quickly can that change, given what seems like a potentially imminent threat from Russia and elsewhere?
No, this is important stuff, Darren. And really, I think the really key point here is that notion of production, of scale, of making sure that Europe, and I include the United Kingdom in this, actually has the capacity to make the requisite armaments and so on and so forth. Now, at the moment, we're just not there. Right? We don't have that scale and production where we need to be. So the DSR Bank, the Defence Security and Resilience Bank, would look to have members not only from Europe, but also the United States. Why? Because the United States has the largest defense industrial base. And so whilst I understand and indeed agree there is a need for Europe to beef up its own defenses and production capacity, it would be crazy not to involve the United States at this point in order to actually leverage that whole defense industry and use that because of the imminent threat, as you talk about, whilst we're building up Europe's.
But there are many people who would sit here and suggest that the United States is not possibly a trusted ally anymore. I mean, one of the criticisms of the UK is that we have to rely on the US for a lot, that we actually independently can't act ourselves, that if Donald Trump woke up in a bad mood and decided that he wanted to undermine the UK's defence capabilities, he could do so. What you seem to be suggesting is carrying on down that route, and many people would say that's not wise, given where the US administration is right now.
We can see the logic of that argument, given the geopolitical context, but equally, let's flip that around a little bit. Let's flip it around and imagine that Europe was solely to try and do things by itself immediately. It's simply not credible. Right? The facilities, the production capacity, the beefing up, it's not there. We would be exposing a huge grand strategic risk vis-a-vis the Russians, and actually it'd be a huge win for Russia. So that is, I simply don't accept that the way in which the relationship between Europe, the United Kingdom, Canada, and in fact NATO and the United States is simply going to get torn up overnight. Okay. And actually more practically, the defense industrial base is predominant in the US, and therefore we have to think a little bit more with cooler heads as to how we get what we need to be able to defend Europe whilst we build that capability.
There you go. That was Rob Murray speaking to me a little bit earlier. Now, it's been 5 years since British workers began to leave the office en masse. Most companies were quick to adopt with hybrid working, but many are now telling the staff they need to return to the office full time. So how are workers feeling about giving up some of the newfound freedoms? Let's speak to Janine Chamberlain. She is UK head of LinkedIn. Very good morning to you, Janine. How are workers feeling?
We've done some research around this because it coincides with the launch of our Experience Centre, which is a location specifically built for the hybrid era. And what we know is that UK professionals really value flexibility, but they also see value in coming together in person, because being in person really helps to build trusted relationships. It's better for collaboration, and it can speed up decision making. So we're seeing organizations who can adapt to this and can offer flexibility while also creating spaces to meaningfully connect in person. They are the organizations who are in the best place to attract and retain their talent.
What we are talking about here, Janine, though, is hybrid working. As you say, I think most people seem to accept there is some value, at least, others would argue a lot of value, from being in the office a couple of days a week, that you get to know colleagues, spend time with them, collaborate, that sort of stuff. What do you make, though, of companies that are insisting people need to go back to the office full-time, 5 days a week, like the old days?
So I think there isn't a one-size-fits-all for companies. Companies are going to have to make those decisions that are fit for their business. And I would encourage companies to really listen to employees and kind of offer a way of working that is best fit to get the maximum productivity out of the workforce. And what we can see in our research is that a third of C-suite leaders in the UK are actually considering reviewing their hybrid working policies this year, with 41% of C-suite leaders saying that they do want to offer more flexible in-office hours to ultimately enhance the productivity and make sure that they can retain talent, because that is a big concern for leaders right now.
And how are you finding that your users, workers across the UK, are reacting to what's been mooted by some, this idea that people may get paid more if they go into the office? I mean, it's not necessarily insane. We know there is the London waiting, for example. So if you work in London, you can earn a bit more money than if you do elsewhere in the country, given the cost of living in the capital. Do you think that might be a way of reconciliation for employees and employers?
I think what we're seeing in our data is actually around the impact of being in person and the impact that has on, for example, driving business deals. So nearly 75% of the people that we surveyed said that they would feel more confident closing a business deal when they've had an in-person meeting. And almost 60% of those that we surveyed have said that they would be willing to spend more with a supplier that they've had an in-person meeting with. So I think the impact on business results is tangible.
And where does this end up, though? Because there clearly will be tension between some businesses who will insist on this and employees just not prepared to put up with it. Do we know the level of kind of UK workers who say, you know what, I'm going to quit my job if they push me that far, if I have to do 5 days a week in the office?
I know that leaders are really concerned about losing their top talent to those employers who are willing to offer more flexibility. And so ultimately, it's up to employees to make that decision. But I know that people are craving that flexibility, whilst also feeling really positive. Like 72% of those that we surveyed have said that they think it's really fair for their employer to bring them back into the office, as long as that time is spent well. So it's not just about showing up for the sake of showing up in the office, but actually collaborating with each other, making sure that that time is meaningful. And we know that it has some really positive impacts on the relationships, on the decision-making, and on the collaboration. So it's about being thoughtful around how we bring people together in the office.
OK, and just very finally, Janine, on a slightly different note, just looking at the kind of wider macro situation here at the UK, we know that, you know, the rates at which jobs are available has been under a little bit of pressure recently. There's a bit of concern about employment in this country. This comes at a time, of course, in which Labour are introducing and strengthening, as they would see it, employment laws. What impact do you think that's all going to have in terms of vacancies and job opportunities this year in the UK?
Yeah, I think naturally we can see that policies do have an impact on the labor market. Like what we can see in our data very clearly is that there's actually a bigger trend. So notably around skill. And we're seeing a real shift in the skills that are required to do our jobs today. So looking at your job and my job, the job that we are doing right now, if we don't even change in the next 5 years, we still have to get upskilled by about 70%. That's how much our skills will change. And that's accelerated by the rapid advancement of generative AI. And so what we're seeing is that there's a real need for us to invest more in the skills of the future, which is actually where LinkedIn is really investing in opening up free courses online for anybody who wants to learn those skills in the future and be in the best possible position to get the jobs that are available with the skills that are still high in demand right now.
Upskilling by 70%. I don't know if I've got that capacity, Janine, there, but we will see. Thank you very much indeed for your time, Janine.
Thanks, Sarah.
Chamberlain there. Thank you. OK, still to come here on Business Live. We're going to be talking about why the UK is lagging behind the rest of Europe when it comes to 5G. If you're frustrated and want to know why, stay tuned.
We're trying to see as much as we can.
We start with breaking news. Historic day here today.
The golden age of America begins right now.
A long-awaited ceasefire is now underway.
First question, Sky News.
This is a huge moment.
It's incredible.
Now to California.
Do you owe citizens an apology? Have you nothing to say?
Jane Secker, Sky News. Would you like to respond to us now?
Beth Rigby, Sky News.
In principle, would you agree to do that?
Criticism of you is banned. How is this a fair election?
The cameras are poised, waiting to see what the president might do next.
Thank you. Thank you all.
I'm Siobhan Robbins, Sky's Europe correspondent based here in Berlin.
In Sweden, police have seized a lethal stash.
Anyone of any age could say, I'll do that for £1 million and then have to go and shoot someone.
Yes. Sky News, the full story first. I'm Greg Milam and I'm Sky's Chief North of England correspondent.
This is insane. This was a bustling residential area.
I'm Yusra Al-Bagher, Sky's Africa correspondent based in Johannesburg, South Africa.
How difficult is this to police tonight?
Off the scale. I'm Dan Whitehead, Sky News' West of England and Wales correspondent.
We're going to do this 100 times every day for the next 3 months.
Why have we agreed to this?
Raises many questions about many things.
Actually seeing people impacted. She was so upset.
It was powerful. They kind of couldn't believe they were being berated here.
Very much on my terms, I think was the subtext. News happens fast around Donald Trump.
It was a kind of wow moment.
Yeah, that's what it feels like, doesn't it?
It's Trump world, and we just live in it.
So, where next?
Follow Trump 100 wherever you get your podcasts.
We're rolling. Welcome to the world.
Our new podcast, starting now. It's very exciting. Every week, we'll be reporting from the world's trouble spots.
We get to hold those in positions of power accountable, and we get to ask the questions that the audience, the listeners, want to know about.
And that's why it is so important that people tune in, come along for the road, come along for the journey. It'll be fun.
$1,500 movies? I don't want this flight to end. Fly Emirates. fly better.
Now, very welcome back. London is lagging behind the rest of Europe when it comes to 5G mobile connection. That's according to a new report today. According to the network testing and monitoring company, MedUX, Europe itself is also struggling to keep up with the rest of the world. Well, let's go to the Mobile World Conference in Barcelona. Speak to Rafael Gonzalez, who is there for us. Very good morning to you. Big question is, why is it so bad, particularly, it seems, here in the UK?
Good morning, Darren. Thank you very much for having me. I think here, Barcelona is the place to be when it comes to 5G connectivity, definitely. And we could find some of the answers why London is lagging behind, and not only Europe, but particularly London. So in MedUX, we have recently formed a massive research study in 15 major European cities while driving 5,000 kilometers all around. And what we found out is that Europe in general lags behind the 5G universal 5G coverage targets when it comes to the digital decade strategy.
And is this because, and we're looking at them, there's just not enough mobile phone masks in particularly big cities?
Yeah, that's a very good question. Indeed, there are several misconceptions in general when it comes to 5G, okay? So first, if a location is theoretically covered by 5G, so there is a must, as you were mentioning, so users expect to enjoy a reliable high-speed 5G connectivity. However, our field data tells a little bit a different story. So true 5G connectivity is not only just about network signal presence or having masts around, it's truly connecting to the network. And secondly, many users assume that when their phone displays a 5G symbol, they are connected to a genuine 5G network. However, our field studies show that the devices misrepresent true 5G connectivity status up to 20% of the time.
OK, and just very briefly, though, on satellites at the future when it comes to even mobile phone signal?
Yeah, I mean, NTN or direct signal from satellites to the network, to the mobile devices will be probably the future. And it's a very complementary solution when it comes to 5G coverage in remote and rural areas. Of course, it will be a great complement, but it is still to see or to be seen if it can really deliver the 5G expectations that come about that are about ultra high speeds, reliable latency, and very stable and reliable services all across the panel.
Great. Well, fascinating stuff, and hopefully it gets fixed, because there is nothing more frustrating than not being able to get mobile phone signal these days. Rafael, thank you very much indeed.
Thank you very much to you, Darren.
OK, that is...
Thank you.
Thank you. OK, that is it from me on Business Live for today. We're back, of course, at 4:30 this afternoon. Up next, it is Prime Minister's Question Time. We've seen Keir Starmer leave Downing Street to head to Parliament. Of course, that is with Kemi Badenoch and indeed our very own Jane Secker and Beth Rigby to guide you through PMQs. Stay tuned for that at the top of the hour here on Sky News.